Filing taxes for an LLC partnership can seem complex, but understanding the process is crucial for business compliance and maximizing tax benefits. An LLC, or limited liability company, combines the limited liability protection of a corporation with the tax simplicity of a partnership. By default, multi-member LLCs are treated as partnerships for federal tax purposes, meaning they're pass-through entities where income flows directly to the members' personal tax returns. Before diving into tax filing, you need to ensure your LLC is legally established. This requires obtaining an employer identification number from the IRS, even if you don't have employees. You'll also need to register your LLC with your state, typically through the Secretary of State's office, by filing a certificate of organization. When it comes to taxation, LLCs have flexibility in how they're classified. While the default for multi-member LLCs is partnership taxation, you can elect to be taxed as a C corporation using Form 8832 or as an S corporation with Form 2553. Each classification has different implications for how income is reported and taxed. For partnership taxation, the LLC must file Form 1065, which reports the business's income, deductions, and other financial information. This form doesn't calculate tax owed by the entity itself, but rather shows the IRS how much the business earned. Each member receives a Schedule K-1 detailing their share of profits, losses, deductions, and credits. Members then report this information on their personal tax returns. It's important to note that members pay tax on their share of LLC income, whether or not they received cash distributions. LLCs must choose a tax year and accounting method. Most use the calendar year, unless the IRS approves another method. For accounting, you can use either the cash method, where income is reported when received and expenses when paid, or the accrual method, where transactions are recorded when earned or incurred regardless of when cash changes hands. Distributions and guaranteed payments are handled differently for tax purposes. Distributions represent a member's share of profits and aren't taxed when received, since the income was already reported on the K-1. Guaranteed payments are more like salary payments to members for services rendered, and are subject to self-employment tax. When filing taxes for your LLC partnership, you'll need several documents: a year-end balance sheet including any properties purchased, a profit and loss statement categorizing all expenses, and a complete listing of all partners and their ownership shares. Common tax mistakes include misclassifying guaranteed payments as distributions, failing to file K-1s for all members, using incorrect accounting methods, and missing deadlines. These errors can result in penalties and increased audit risk. Beyond federal requirements, most states have their own filing requirements for LLCs, which may include state partnership returns, franchise taxes, and annual reports. Requirements vary by state, so check local laws and deadlines. The deadline for filing Form 1065 is March 15th, or the 15th day of the third month after the tax year ends. Missing this deadline can result in penalties of $220 per member per month for up to 12 months. You can request an extension using Form 7004, but this only extends the filing deadline, not the payment deadline. Maintaining detailed financial records throughout the year is essential for accurate tax filing. Many LLC partnerships work with qualified tax professionals to ensure compliance and optimize their tax position. Understanding how to properly file taxes for your LLC partnership helps you maintain good standing with tax authorities, while ensuring you take advantage of all available deductions and benefits. With proper planning and record keeping, tax season can be manageable rather than overwhelming for your business.